Guy walks into a tax advisor's office in Dallas last month with $400,000 in capital gains from selling his online business. Asks how to protect it. The advisor shows him a cattle ranch investment in Montana. He walks out paying zero tax and getting paid monthly by ranchers leasing his land. Different guy, Phoenix, software engineer making $300,000 a year, buys a duplex, shows a $50,000 loss on paper, actually makes money every month. Third one, my buddy in Houston drills an oil well in December, writes off 80% of his investment in that tax year, well, hasn't even started producing yet. Here's the question nobody asks. Why would the government actively pay people to make these investments? Look, I'm going to show you how the tax code actually works as a payment system for doing what the government wants, why almost nobody uses it correctly, and the specific investments where the IRS becomes your business partner. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose weak points in your plan. I only ask for your email to send the report so I don't store your financial data. Link in the description. Think of the government as a venture capitalist with the worst deal structure you've ever seen. They take 30 to 40% of your profits every single time you make money. No negotiation. But here's what nobody tells you. That same venture capitalist will also fund 30 to 40% of specific investments if you just know which ones they've pre-approved. The whole system runs on one central mechanic. The government needs things built: housing, energy, food, technology. They figured out they're terrible at building these things themselves, so they wrote a payment contract into the tax code. You build what they need, they fund part of it through deductions and credits. It's not a loophole. It's the actual business model. Here's where it gets interesting. In 1986, Congress completely rewrote the tax system. They eliminated most deductions for regular people. Doctors, lawyers, employees. Basically, everyone got their write-offs stripped. But they expanded deductions for real estate investors, energy producers, and business owners. Why? Because employees don't build the infrastructure the country runs on. Investors do. So the tax code became a sorting mechanism. It identifies who's just making money versus who's deploying capital into government-approved projects. And it pays the second group. I was sitting with my tax attorney in 2021, looking at my business returns. I'd made about $700,000 that year. I asked him, what's the actual difference between how I get taxed versus a surgeon making the same amount? He pulls up two returns, same income, completely different tax bills. The surgeon paid $240,000 in federal tax. I paid $68,000. Same earnings, different systems. The surgeon optimized for income. I optimized for the tax code's incentive structure. He got paid for his time. I got paid for deploying capital into assets the government wants built. Now you're probably thinking, this only works for rich people. Here's the thing. A buddy of mine started a tiny consulting business 3 years ago. Works from home, makes about $90,000 a year. His taxable income, $52,000. He didn't hire fancy accountants. He just understood the home office deduction, the vehicle write-off for business use, the equipment depreciation. The government paid him to start that business through the tax code. His effective subsidy in year one was about $8,000. More money back than he spent launching it. But this is where the psychology gets weird. Most high earners actively avoid learning this system. I've watched guys making $500,000 a year refuse to buy rental property because they think real estate is too complicated. They'll spend 6 hours researching which index fund has a 0.03% lower expense ratio, but won't spend 20 minutes understanding depreciation. It's not laziness. It's identity. They see themselves as employees who invest, not investors who might have a job. The tax code doesn't care about your identity. It cares about your activity. Let me tell you about depreciation, because this is where the government's payment system gets absurd. You buy a fourplex for $1 million. Put down $200,000. Finance $800,000. The building is worth about $800,000. Land is $200. The IRS says that building is wearing out even if it's actually appreciating. So they let you deduct the wear and tear. Standard depreciation over 27 and a half years would give you about $29,000 a year in deductions. Fine, decent. But then there's cost segregation. You hire someone to break down everything inside that building. The appliances, the carpets, the cabinets, the wiring, all that stuff depreciates faster, usually about 20% of the building's value. With bonus depreciation, you can write off that entire 20% in year one. That's a $160,000 deduction in year one. On a property you only put $200,000 into. You got an 80% first-year write-off on your actual cash invested. Now, here's the kicker. That deduction saves you money based on your tax rate. If you're in the 37% federal bracket, that $160,000 deduction just put $59,000 back in your pocket. You invested $200,000. The government gave you $59,000 back immediately through tax savings. And you still own an asset that's probably going up in value and paying you rent every month. The bank financed 80% of the purchase. They get 0% of the tax benefit. You get 100%. You leverage the bank's money to multiply your tax deduction. This is the part that separates people who stay upper middle class from people who actually build wealth. The wealthy don't just leverage debt for returns, they leverage it for tax benefits. But now you're thinking real estate sounds like work. Fair? Let's talk about oil and gas. This is where the government's incentive structure gets truly unhinged. You invest $100,000 into a drilling project in Texas. Partnership sends you a Kone at the end of the year, $80,000 deduction in year one. Before the well even produces, the IRS categorizes most drilling costs as intangible: geological surveys, drilling labor, site prep. Intangible costs get deducted immediately. Tangible costs, the actual equipment, gets depreciated. But here's what makes it insane. You can invest in December, they don't drill until March. You still get the deduction for that tax year as long as they have the lease and the plan. I've got a client, owns a software company, makes about $1.2 million a year. December 2024, he sees his projected tax bill, $430,000. He calls me. I connect him with a drilling fund in Oklahoma. He invests $250,000, gets a $200,000 deduction, saves $74,000 in federal tax. The well starts producing in 2025. When the revenue comes in, he only pays tax on 85% of it. The other 15% is permanently excluded. It's called depletion allowance. So he got paid to invest through the tax deduction, and he gets paid to receive income through permanent exclusion. The government subsidized both sides of the transaction because they want energy independence. This is the part nobody explains clearly. These aren't tricks. They're explicitly written into the code by Congress. Section 179 for equipment, Section 168K for bonus depreciation, Section 469 for passive losses, Section 1397 for opportunity zones. Each one is a direct payment mechanism. The government is literally publishing a menu of investments they'll subsidize. Most people never look at the menu. Let's do a case study with actual numbers, because this is where it gets concrete. Meet Sarah. Composite of a few clients, but the math is real. She's a VP at a tech company in Austin, makes $450,000 a year. Married, files jointly. Her W-2 shows $450,000, her husband makes $80,000, combined $530,000, standard deduction $29,000, taxable income $501,000, federal tax bill roughly $147,000. She pays that every year for 5 years straight. That's $735,000 to the federal government. Now, same scenario, but she reads the government's payment menu in year one. She keeps her job, but starts 3 things. First, she opens a small consulting LLC, does about $30,000 a year in side work related to her expertise. Home office deduction, vehicle write-off, equipment. Knocks her taxable income from that down to $18,000. Net tax savings, about $4,000. Second, she buys a short-term rental in the hill country. Purchase price $750,000, puts down $150,000, finances, $600. Cost segregation study shows she can deduct $130,000 in year one. That deduction offsets her W-2 income because she qualifies as a real estate professional by spending 750 hours managing properties and more time in real estate than her main job. Saves $48,000 in federal tax year one. Third, she invests $75,000 in a qualified opportunity zone fund in Houston, rolling over capital gains from stock sales. Defers $50,000 in capital gains tax. If she holds 10 years, she pays zero tax on the QOZ gains. Year one, total tax savings, $102,000. Over 5 years, assuming she continues the strategy, she saves roughly $420,000 in federal tax compared to just being an employee. Same income, different structure. The government paid her $420,000 to deploy capital into real estate and opportunity zones instead of just earning a salary. Here's the comedic part. Her CPA told her in year 3 that she was being too aggressive. The CPA worked primarily with W-2 employees and didn't understand real estate professional status. Sarah fired her and hired a firm that specializes in investors. New firm found another $30,000 in deductions she'd missed. The person paid to minimize her taxes was accidentally maximizing them due to expertise mismatch. This gets darker when you realize why financial advisors don't tell you this stuff. I was at a wealth management conference in 2023. Guy on stage manages $800 million for high net worth clients. Someone asks why he doesn't help clients with tax strategy like cost segregation or opportunity zones. His answer? Not scalable. He gets paid on assets under management. If clients pull $200,000 to buy rental property, that's $200,000 he's no longer managing. His fee drops. The incentive structure pays him to keep your money in the market where he earns his percentage, not to teach you the tax code where the government pays you. It's not a conspiracy. It's just math. His business model and your tax optimization are misaligned. Now let's talk about the thing that sounds completely fake but is absolutely real. Conservation easements. You own 100 acres in Montana. Beautiful land, borders a river. A developer offers you $3 million to subdivide it into 52-acre parcels. You say no, you want it preserved. So you donate a conservation easement to a land trust. You still own the land. You just legally restrict it from being developed forever. The appraisal says the difference between development value and restricted value is $2.4 million. You just donated $2.4 million to a qualified charity. That's a charitable deduction. If you're in the 37% bracket, that's an $888,000 tax savings over the next 6 years as you utilize the deduction. The government paid you almost $900,000 to not develop land. You still own it. You just can't build condos on it. Here's the other one that sounds insane. Farmland. Guy I know sold his company for $12 million in 2019. Wanted to reduce his tax exposure long term. Bought a Wagyu cattle ranch in Nebraska. $4 million purchase. The herd, the equipment, the feed, the farmhands, the buildings, all deductible. His ranch operates at a paper loss every year of about $280,000. That loss offsets other income. He's paying $70,000 less per year in tax while building a productive asset. The government is subsidizing his transition from tech entrepreneur to cattle rancher because food security is a national priority. Now you're asking yourself, is any of this actually legal? Yes, aggressively legal. These are direct incentives written by Congress, upheld by courts, used by billions of dollars in institutional capital every year. The difference is institutions have teams of tax attorneys reading the code. You probably don't. But the code doesn't care about the size of your team. It cares whether you followed the rules. A guy with $200,000 investing in a drilling partnership gets the same percentage deduction as a fund with $200 million. The mechanism is identical. But here's where everyone screws it up. They treat taxes like something that happens to them in April, instead of something they control all year through investment decisions. Your tax bill isn't determined by what you earn. It's determined by what you do with what you earn. The government publishes the formula annually. Invest in real estate, take depreciation. Invest in energy, take depletion. Invest in opportunity zones. Defer gains. Start a business. Deduct expenses. Do none of those things. Pay full freight. It's a menu, not a mystery. I've spent 10 years running my own business, sitting in rooms with accountants and tax attorneys who explain how money actually moves through the system. I've got multiple hundreds of thousands invested, all following this exact playbook. It's not theoretical, it's mechanical. The people who figure this out don't work harder. They just read the instructions the government already published. Last thing, the psychology here is everything. Most people optimize for feeling smart about their investments. They'll research expense ratios and Sharpe ratios and diversification theory. That's fine. It's also irrelevant to your tax bill. The tax code doesn't reward smart investing. It rewards specific behavior: building housing, producing energy, preserving land, starting businesses. If your investment strategy doesn't include any of those activities, you're paying full price. If it does, the government becomes your limited partner, funding 30 to 40% of your basis through tax savings. Lazy investing built more wealth than crypto memes. The people quietly buying duplexes and writing off depreciation while working their job didn't get rich quick. They got rich inevitably because the math only goes one direction when the government is subsidizing your cost basis. So here's what you actually do. 3 things. First, if you're making over $200,000 a year and you're not using the tax code's investment incentives, you're leaving 6 figures on the table over a decade. Minimum. Start with one asset class. Real estate is the most accessible. Buy a rental property. Do cost segregation. Learn the system by using it, not reading about it. Second, hire a tax strategist, not just a preparer. Preparers tell you what you owe. Strategists tell you what to buy to owe less. They're different jobs with different incentives. Pay for the second one. Third, stop thinking like someone who earns money and pays tax. Start thinking like someone who deploys capital into government-approved projects and gets paid through the tax code. That mental shift is worth more than any individual deduction. The government will literally pay you to invest. They publish the payment terms. Most people never read them. And then they wonder why their tax bill stays high, while their neighbor who bought a fourplex somehow pays nothing. It's not luck, it's code compliance. You're just complying with the wrong part.